Once again, I've got two words for you: market volatility. That's the name of the game right now, especially with a CPI print coming out tomorrow morning at 8:30, and pair that with the fact the market's been incredibly volatile already on the Tuesday and Wednesday sessions specifically, and we're not even close to tagging the upper or lower bound of this week's expected move, basically implying that there's a lot of volatility left in the tank that's been priced in for Friday. So the key question to be asking here is this just a volatile pullback and things are still kind of okay? Or is it the start of something much more severe in the downward direction? And that's what we'll look to answer in tonight's episode of the Midweek Market Update. As always, check out the links listed down below in the description, hit the thumbs up button, and subscribe if you've not already done so, and stay tuned until the end of tonight's show. I've got 5 additional trade ideas to share with you that you won't want to miss. With that said, let's kick things off here on our SPY daily time frame chart. What do we see from a trend perspective? Still certainly dealing with an overall daily uptrend with lows, higher lows, and as we know, these are soft higher lows, meaning that the hourly chart never actually flipped into a downtrend. Perhaps more importantly, our highs are highs, equal highs. The breakout has now caused the sequence of higher highs. And even if you like a closing basis, Monday of last week did produce a brand new higher high. So thinking about the trend sequence, we are pulling back from a higher high. The hourly chart is definitively in a downtrend at this point in time. It's definitely reasonable that the daily time frame is looking for a higher low to form that is not a soft low. So what's the key structure that we want to see respected? Well, it would be picture perfect if we turn prior resistance into newfound support. That number is 444, and sort of in an ironic manner, the previous CPI read did cause a gap up, and that's this unfilled gap right here that closes at 443. And notice also, slowly over time, the 50 SMA on the daily time frame chart here will creep higher and provide confluence of support at the gap fill reversal. Once again, 443 is the key number there. So I'm still focusing on this zone to look for any excuse intraday to say, yes, buyers are stepping up. This is looking like the reversal to confirm the daily higher low. And that might look something like an hourly double bottom, an hourly inverted head and shoulders, maybe a daily hammer candle prints, and then we'll look for longs over the top. We'll assess the situation as it unfolds, but this zone is generally where I'm looking for support to step in this overall trend sequence. Now, what's most interesting to me about the gap and the interactions thus far at the top of the gap really tell us a lot about the participants in the market currently, right? You'll notice that the low of Tuesday and Wednesday, today's session, are nearly identical and go right to the top of the gap. And it begs the question, if stronger sellers were getting involved in this market, perhaps sellers with a 6, 9, 12-month time horizon, do they care about a very nuanced and visual level like a gap? And the answer is probably no. They just want to either take profit on their positions and sell the market, or they want to initiate new money shorts and just say, get me in, I think we're towards the top, we need to fill this order, right? They don't look at market structure to this degree. That's what we would call OTF, right? Other time frame traders. So in my eyes, this is not so much new money sellers entering the market or OTF larger time frame players. It's much more so just downside volatility. We had the Bank of Japan news, credit downgrade, Apple earnings, and although these things do make for really solid bearish stories, until the trend actually reverses in the downward direction, I'm not willing to throw in the towel for our daily higher low. The next thing to at least acknowledge before we continue on down to the hourly chart is that this is not going to be an easy reversal in the upward direction because, of course, we're caught between a rock and a hard place, right? So we have this key structural support that we're watching underneath us, but we also have to contend with this level overhead, which marks the overhead supply, right? If anybody who is long from in here wants out for break even, the first place that they're going to sell is at 451.50, the retest of the bottom of that range. So there's still very much so the opportunity for a daily reversal off of this zone down here. Again, let's say it comes from a hammer. We see a move in the upward direction. The next big battleground is 451.50 if this truly does hold up for a daily higher low at your gap fill reversal and your daily 50 SMA. One other piece of confluence for support before we move on down to that hourly is coming in with the Fibonacci's from our last higher low to the higher high that we're pulling back from. Notice that the 61.8 is confluence of support at the top of the gap. Generally, what we always say is the 61.8 is the line in the sand. If we start spending more time underneath, we will change our tone and we will look for a 100% retracement. It works in both directions, up and down. We cannot deviate from that as a technical indication. So I like the fact that so far it is acting as support. If we do close the gap and we have to go all the way down to 443, I would like to see a recapture and then some sort of structure that builds out like this to then look for the daily higher low that would kick off the move in the upward direction to retest 451.50. We will change our tone on this market if we get a solid close underneath the gap or towards these as equal lows. We will become much more neutral for the market, and as soon as we get a lower high, you better believe it, I'll be the first one telling you we are now in a daily downtrend, right? So that's the daily. Let's move on down to the hourly chart and get a little bit more granular here for a game plan into the remainder of this week. First and foremost, I just want to highlight the volatility. Obviously, it's back and forth, it's wild, and it's just that, right? It's a volatile market in here, but it's not necessarily overly bearish, and we'll see proof of that in the internals in just a moment as well. So the game plan going forward is if we open in this as a balance range, if the bears are going to make a stand, they'd, in a picture perfect world, form a lower high on the hourly chart here under 447.50. Why? Right? We're already in an hourly downtrend. We know that highs, lower highs, lower highs. In a picture perfect world, they continue that sequence with lower highs underneath 447.50. So that's the downside. If we open in range, rejections there, we're looking for the gap to close, and then we'll reevaluate down here once again for all of those structural patterns we were just referencing. Could be a double bottom, could be an inverted head and shoulders, could be a daily hammer candle that then subsequently sets up the move for next week if that prints here around 443. Right? So that's what we're looking for on this interaction opening in range with a lower high underneath 447.50. If none of these patterns here, double bottom, inverted head and shoulders, hammer, if none of those form on the gap fill reversal, then guess what? There's no shot at taking a stab long in there. There's no confirmation of a reversal, right? So that's the downside. And then, beyond that, your next structural target would just come in at 439.50 if there's no setup. If there's a bearish setup underneath the gap close, meaning, I don't know, let's just, forecast that maybe there's a bear flag down here, the break would be into 439.50, right? So that's your downside. In terms of upside, notice that on the Tuesday and early on today's Wednesday session before this afternoon close, we were starting to get a double bottom, and that produces the top of the range, or what we could consider a neckline of the double bottom at 448.75. You need to get an hourly higher low above that level before starting to think about longs if we open in range and start trading in the upward direction, right? We can get some sort of other structure down here to buy the pullback, but if we open and stay within range, to reverse the hourly downtrend, you need a higher low above 448.75, and then we could trade for that upside outcome to retest the big daily level at 451.50, right? The bottom of this as overhead supply. So that's the roadmap that I see going forward here on the hourly. Let's throw on our anchored view apps here and see if they confirm any of this. And I would argue, yes. I mean, the Bank of Japan and Origin anchored view app from back here, those are confirming that 451.50 will be a big battleground. And the anchored view app from the credit downgrade from Fitch here is also confirming that this level, 448.75, needs to be recaptured with a higher low before thinking about upside outcomes, right? Other than that, you're just playing chop in this volatile range and not really doing anything impressive, right? So that's the hourly game plan here. Let's take a look at some supporting evidence. Market internals are always Exhibit A. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. For the most part, does this screen indicate an overwhelming bullish, bearish, or neutral edge for the market? I think it really speaks for itself. It's about as neutral as it can possibly get. No individual day breaches positive or negative 300 million in terms of volume flows. The net flows on the week thus far, 3 days in, are negative 109 million. Substantial reads, usually by the halfway point, we're looking at 300 to 400 million, not even close. In terms of the advanced decline line, we're sideways on the Monday session, still right around 850, 750 positive. Tuesday, I'll give some credit where credit is due. The bears do open in trend lower zone, but by the time the close comes around, we're trending aggressively away from trend lower zone. And obviously, the price action speaks for itself on Tuesday. Today's session, where we experience the most volatility, look at the flip back and forth through the zero line a number of times out of the advanced decline line. That's indecision, that's indecisiveness, that is totally not higher conviction shorts entering the market with some, solid power behind them, basically. If we look at the cumulative ticks down below, I would have a very similar comment. The concept is exactly the same. Flipping back and forth through the zero line, especially in the cumulative tick, is something that totally indicates volatility and chop, not an overwhelming edge to either side of the market. So once again, this sort of aligns with the idea we were talking about from the daily, that stronger sellers, OTF sellers, are not necessarily getting active here. I think we're still looking for, with this evidence, a higher low pullback to develop. We're looking for hourly structure that would confirm the daily higher low. Exhibit B is always the market profile. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. There's no need to overcomplicate this one. Value area on Tuesday, as well as today's session Wednesday, are opposing. On Tuesday, it's lower in the profile, as is the point of control, and on today's session, it's higher in the profile. Nonetheless, this would reaffirm the volatility and just that we're stuck in a 2-day balance. So to some degree, balance rules are in play, and we saw this on the hourly time frame chart, right? If we open in balance, a lower high that breaks the bottom gets interesting for downside outcomes. The time where we have more confident longs is on a break and retest higher low above the top of the balance. Once again, with value areas opposing, it's not like we have an overwhelming edge there. The one takeaway that you might get from the market profile is that all of this is happening underneath the point of control from last Friday's session, which does strike me as a very slightly more bearish than bullish indication, which is why we are looking for downside outcomes first, just like we talked about on the hourly time frame chart. Jumping back on over to the platform to evaluate the weekly performance of our sectors reveals that the XLV healthcare sector leads the pack up 1.6%, and at the bottom of the barrel, it's the XLK tech sector, heaviest weight risk on sector, down a whopping 2.19%. This is starting to feel much more like a risk off rotation now, a little bit more explicitly, with things like energy remaining green, even real estate as a hard asset, right? A little bit defensive there, that's green. Utilities and consumer staples, defensive and green. And then in the red, it's discretionary, financials, and communications, right? So risk off rotation is starting to feel much more so like a real thing, but let's look at the structural charts and evaluate how much damage has actually been done here. And to be honest, there's quite a bit of damage in the XLK chart. We'll look at that in just a moment. But XLV, healthcare sector, second heaviest weighted sector by market cap, but as we know, it's definitely more D for defensive. So as the market pulls back, as the SPY pulls back and the XLK is getting beat up, the XLV moving higher is actually cushioning some of the damage that's being done. So as long as this remains elevated, and once again, we've pulled back, we've found a beautiful daily higher low above prior structure, so trend-wise, it's making sense. As long as this holds up and continues that sequence, that will be helpful for the bull case in the broad market. Now, noting the daily structure of today's bar, it's an inverted hammer. If everything is flushing tomorrow, you're going to see a big concern for correlation in the downward direction. We'll get to that as we talk about utilities in a moment here as well. Here's energy. Again, not really overly concerned. Yes, risk off rotation is taking place with the break of the balance here, but remember, it's just cushioning the blow to the S&P. It's not divergent in the sense that the lightweight risk off sectors are leading the market higher, but it is cushioning the blow for the S&P as we're pulling back. The risk is when everything now correlates in the downward direction. Real estate, it's a nothing burger. It's sideways in the range. It's a really lightweight sector, not worth spending time on. The XLI, sideways in the range, but close to the all-time highs. Like, I would concede that maybe this turns into head and shoulders, but I would become much more concerned when and if we break down underneath the prior all-time high at 107.88. We're not there yet, but it's certainly not helping the bull case just going sideways. You want to see this get in gear up and over 110 with price acceptance. Utilities, this is where the red flags start going off, right? We talked about correlation in the weekend update. We talked about the 100% retracement, how being short in the hole is a terrible idea, but a lower high underneath 65 with an equal low flush, big red flag for the broad market. Look at the structure that printed on today's session. Inverted hammer, rejection for a lower high underneath 65. If the risk off sectors start to flush tomorrow and we're not seeing the slack being picked up by the XLK, XLF, XLC, XLY, it's going to spell recipe for disaster. So the structure is there for a larger downdraft in the market if utilities start to break down underneath 63.75. And it gets worse, we can look at consumer staples, right? Inside bar on today's session, inverted hammer after multiple tests to the same level. If there was going to be an ideal daily higher low, it was here at 74.70. Obviously, with the multiple tests and no indication of a reversal here, as a matter of fact, the bearish indication from the inverted hammer, if this flushes, once again, you get your full correlation with even the risk off sectors taking a beating on tomorrow's session. So that's the primary threat that I can see for the downside as we move into the remainder of this week. XLK, we've got to chat about it because there's been some damage done, right? Obviously, we know, just like the QQQ, we are in much more firmly of a daily downtrend that's starting to emerge. You'll notice also that we did not hold the daily 50 SMA. The saying goes, nothing good happens underneath the 200 SMA. We're going to adjust that for today's video. Nothing good happens underneath the daily 50 SMA for our XLK into the end of this week, right? Jokes aside, your key level to hold is right here. It's got to be 167.65. If we're underneath that, there's a huge threat that we start to go head and shoulders, right? Even like a major lower high, head and shoulders, and the trend is slowly going to start reversing, right? The best thing that could happen for the XLK is a sharp reversal that recaptures the daily 50 SMA. You got to get above that if you're going to avoid the head and shoulders that looks really, really, damaging like this on the lower high. So that's the primary watch. Just like in the S&P, if it does get some legs, if there is a strong reversal tomorrow, let's just say that CPI comes in way better than the expectations across the board, core and otherwise, and there's a big reversal closing above, it's a good first step, but just like the S&P, you've got to contend with your overhead supply. So we're changing our tone here specifically in the XLK because this is the heaviest weight risk on sector. There's some damage here to this trend. It's feeling much more like a downtrend or maybe even weekly neutral trend now that we're going sideways in this as an overall range, right? This key support, 167.65, needs to hold, and no indication from today's daily bar would suggest that it's rainbows and butterflies here. So watching very closely the XLK at 167.65. So enough of that one. We'll move along to the XLY, consumer discretionary. Here's your sideways range. Remember that Amazon saves the day, and we're stuck still in that range. So there's the opportunity, I suppose, for an inverted head and shoulders, but remember, you just need the price acceptance over the neckline. Once again, today's daily bar, no indications of that whatsoever. So if you're banking on the bull case for tomorrow's session, it's either got to be a pullback first that fills the gap and reverses, or a CPI gap up or push higher that gets us over some of this key structure in our sector. So that number would be 172.60. Watching this very closely. As of right now, it's still neutral. Maybe you're getting lower high, lower low. So keeping an eye on that dynamic, but I would side more so with neutral out of the XLY. This, as we know, is where things really start to deteriorate under the 167.25. Speeding it up here, XLB, lightweight sector, materials, as we know, but undoubtedly bearish pattern, right? Head and shoulders. Key support, I would expect further downside with today's session, building out that right shoulder and threatening a close under the neckline. Under 83, 82 becomes the target. Lightweight sector, but it will put downward pressure nonetheless. XLF, financials, got to do some talking about this one as well. If it's going to be a double bottom, meaning this on the hourly chart as a pullback for a daily bull flag, right? Here's daily bull flag. Here is hourly double bottom. Let's just show it, right? Let's move on over. If this is kind of like the structure that we're looking for, it's got to be obviously higher lows over the neckline, 35.25. We're just not there yet, especially with the daily bar, which is red closing weak on the lows. So I would say that the threat is for further pullback. We can technically afford a weekly pullback that would go to the top, the retest of this range, something that looks like this over time, obviously into the end of this week. Once again, the risk is for full-blown correlation. So if that pullback does continue, you're getting red out there in the market, right? Next up, last but not least, communications. It's starting to show the head and shoulders, just like everything else. So we're at this like sort of tipping point in the market, which is really interesting and worth pointing out. Remember that we said, when everything was fine and dandy back here, the reason that we covered it day in, day out, week in, week out, is to make it very clear that when things change, we'll know exactly that they're changing, right? So this head and shoulders starting to emerge out of communications. Other things are deteriorating. We're not all the way there yet for a daily downtrend, right? This is possibly your daily high or low, but the red bar, once again, structure that closed out today, it's not all that thrilling, right? So you really need the saving grace of higher lows over 68. I would just round up there on the hourly chart to say, okay, communications are helping out once again in the bull side of the argument. Here's the ratio grid. If you're not familiar with this screen, here's a video tutorial on how to set this one up specifically. But the ratio grid does a great job of also illustrating the subtle shift to more of a risk on turning off type move, right? The XLK, obviously heaviest weight sector, significant deterioration. That's exactly what we just talked about with the overall daily trend right now that it's in a balance on the weekly. The XLV, it's starting to get some legs, right? It's finally up and over that 50 SMA. Remember that this is a D for defensive sector, although it is the second heaviest weight. The financial sector is the only one, as we know, that can still afford the weekly higher low pullback, the daily higher low pullback. and the trend thus in the ratio still looks okay. The XLY, this is your threat. Daily lower high, we're already retesting the neckline if this were going to hold as the double bottom. So this is on the cusp. It's on that tipping point of flipping to a not so helpful look for the buyers out there in the market, which is why we're treading with caution on the SPY daily, right? We're still thinking about daily higher low pullbacks, but as we pointed out on the hourly, we're trading in the direction of the hourly trend first, which is down, and that would be in alignment with some of these subtle shifts in the sector ratios, which are also pointing towards slow transitions to risk on fading and risk off coming into the picture. XLC, it's really sideways. This is honestly a little bit more impressive, and we saw the daily chart as well, still offering a daily higher low. Energy coming in from a risk off perspective, not looking great with the uptick, strong uptrend now over the 50 SMA. XLP threatening the break of the 50 SMA. Utilities not quite there yet, but certainly an uptick on this week's session. Let's take a look at some specific pairs. XLK versus XLU. You're getting that threat of a lower high. If this breaks through the 50 SMA and the equal lows, that's your signal to say, okay, risk off has faded. We will not be as aggressive in this market. If it holds here and we consolidate out, it's a different story. And I still think that your daily higher low is on the table. Similar comments over here for your XLY over your XLP. You've got your lower high, but we still haven't broken down. Even if you want to classify this, right, as a head and shoulders, we're not through that neckline. Remember, it's not a head and shoulders until it is. We need to break the neckline. We're on the cusp. The pattern's certainly there. It looks like it is a risk, but we haven't broken it yet. Checking in on our good friend the dollar, this is certainly starting to feel more like a look below and fail. There's really not much price data to actually analyze this week. We've gone sideways in anticipation of the CPI. It will likely move and have some reaction when the numbers come out tomorrow morning at 8:30. As we know, higher puts downward pressure on equities, lower puts upward pressure on equities. If we take a look at the gold contract, though, this might be a little bit of a forecast that we could read into, not in its entirety, but gold has certainly moved aggressively lower, which would support the idea if we flush this, the dollar is likely to move in the upward direction, watching 1955 out of the gold contract. How about the TNX for our 10-year interest rates? Notice that we're clinging back to the 4% mark. That's 40 on the TNX here. And once again, there will likely be some sort of reaction from the dollar and rates when we actually get the CPI print tomorrow. This is moving lower on the pretense that bonds are being bought up a little bit. If I just show you the TLT, we'll get to this segment in the risk appetite charts, but there was a really nasty oversold move, right? And now we're seeing a bit of a counter trend rally against that. That's what's driving rates down right now, not the forecast that the Fed is really going to be coming in and cutting rates aggressively. And we can confirm that by looking at something like the ZT, the 2-year, which, as we know, if it's stuck sideways in the midpoint of this range, that's much more indicative of the Fed pause. If we're above, it's a Fed rate hike, and if we're below, it's a Fed cut. So let's take a look at the tracker tool and see what that has to say. So no surprises and totally in alignment with what we just analyzed from the inverted ZT, expecting pauses until the first cut, which is slated for March of 2024. In my eyes, what the most important thing to watch tomorrow will be is how the probabilities shift once the CPI numbers come out. Do we decrease the odds of a pause here? Do we increase the odds of a hike? And do we ultimately shift the odds so much so that this is now the favored outcome? That's what we want to be watching for on tomorrow's session. And to give you a brief and general idea of my thoughts on CPI, I think all of the risk is in the downward direction, right? We have too many catalysts with the credit downgrade, with the Bank of Japan news, with Apple earnings, and Apple in general looking pretty weak right now out there in the markets. I think the risk is to the downside because if we miss CPI, obviously it indicates a resurgence of inflation and the Fed has to raise rates one more time, which is uncomfortable for everything out there in the market, right? Tech sector specifically. So, and it also, right, it puts the pressure on the labor market, which so far is like, it's okay. It's not deteriorating aggressively, but there is a slowdown in hiring. We know if we start to uptick in the unemployment rate, that monthly read, right, it's generally really difficult to put the cat back in the bag. That's where the recession starts to come down as a more probable situation. So missing on the CPI, once again, I think all of the risk is in the downward direction, whereas if we beat the CPI print, I think the market just says, okay, it's one more positive report. We're trying to move in the right direction. You get the sense, right? It's not as positive, delta-wise. The net effect is not nearly as positive to outweigh the miss if it's in the downward direction, obviously. So that's my take on CPI. Let's get back to the charts, though. What about the risk appetite charts? Notice that the TLT relative to the S&P is continuing on an uptick here for a counter trend move, but it's still well underneath the resistance trendline. So, volatility, yes. Flight to safety, not all the way there yet, especially if we zoom into the structural chart of the TLT. It looks like a totally reasonable counter trend move until proven otherwise. If we break above and higher low above 99.12, and if this ratio breaks the resistance trendline, we will change our tone, but until proven otherwise, once again, it's really much more so of a volatility indication. We could also look at volatility through the lens of shorter dated bonds in relationship to one another, and you'll notice that these upticks here, they're pretty much holding. They're not aggressively reversing back in the upward direction, so people are favoring the shorter end of the curve, indicating uncertainty, right? Which would be an indication of volatility about the economic future. We could take it one step further. This is an interesting chart that we brought up in the weekend update, the LQD corporate grade bonds relative to what's going on with the IEF, which is 7 to 10 year bonds, right? So we were talking about the rollover look underneath the 50 SMA, and you'll notice it actually upticked and is now flattening out instead of producing this nice even rotation underneath. So watching that very closely, if we do start to get price acceptance above, again, what would that tell us about the markets? For those unfamiliar with the relationship, it would just be an indication that the risk appetite for corporate grade bonds, private, right, is decreasing, and the appetite for government backed, quote unquote, risk free bonds is increasing in the same time frame duration. So that would be another indication for a flight to safety type move out of the broad market. Interestingly enough, though, if we take a look at the HYG, which is even shorter duration than the LQD, but nonetheless, look at the major divergence happening here in the HYG junk bonds versus the S&P. Major. I mean, this one is one of the most blatant divergences we've seen in quite a while. And if this is smart money up above, it would indicate that, yes, maybe we are ultimately just looking at a higher low pullback on the S&P. It's just one data point, ultimately. You're not going to just go out there and buy the S&P with both hands because of this HYG divergence. However, it does stack up as a favorable data point towards either neutral markets or watching for a higher low. Not everything right now is pointing like an Armageddon type sell-off is around the corner. And just to put the cherry on top, May as well, here's Bitcoin on a weekly time frame chart. This thing is unchanged. This is perhaps one of the most quiet weekly periods of consolidation we've seen in a very, very long time, which is just interesting. Again, not one-to-one with equities down below, but from an overall risk appetite perspective, you got to kind of think about that and say, that's fairly interesting. It doesn't seem as though everybody's panicking out of crypto. Give me my money. I need to pay for my mortgage. We're headed into a recession. I need every last penny I could scramble for. It's just not the case. So overall risk appetite it's on the cusp, but so far so good for maintaining more of the bullish risk on edge. How about the market breadth? Certainly deteriorating here out of new highs versus lows, but we are above the zero line. Remember that we want to avoid a look like what we experienced in 2022, not making these big negative impressions. And oftentimes in the early stages of a recovery, it can be difficult to get what would seemingly be really impressive upside reads. So it doesn't strike me as being a cause for concern yet. If we start spending more time under the zero line, we would certainly reevaluate. Let's take a look at something like the SPX A200R, stocks trading above the 200 SMA in the S&P 500. Still a meaningful pullback, but holding over the 50% mark. And actually on this week's trading session, you can see that there's actually a minor uptick. That would be a positive indication for the S&P. Let's take a look at something like the SPX A50R, even more granular, 50 SMA. This is now a daily time frame chart, not a weekly time frame chart, so one-to-one with the price action down below. And as we get a pullback, as we would expect, we've fallen out of Goldilocks zone, but we are still above the 50% mark. So not all the way there yet for full-blown deterioration. When more than 50% of the stocks in the S&P are underneath the 50 SMA, that becomes a little bit more of a threat for stagnation or pullback, as you can see here and here. Let's take a look at the RSP equal weight S&P 500. This is a very interesting case to me because we do have a hammer that was produced on Tuesday with a higher low and not even an attempt to test the low of day on today's session Wednesday, holding the 150 mark as a higher low. That's a pretty constructive look, and as long as that 150 is holding in the RSP, I would say that that probably builds the case for the higher low out of the weighted S&P down below, and we can look for those situations we were talking about for reversals from hourly patterns on the SPY. Let's take a look at the DJI, the Dow, and no major divergences here, right? So this is playing nicely as well, not really throwing any wrenches in the mix of the analysis. VIX volatility is definitely up and over the 15 handle, but what I find most interesting about this is that the S&P dumped into the close, right? Why did the VIX itself not perk up back up towards the highs of today's session? It just simply did not happen. So that's a little bit of a head scratcher to me, which would indicate, okay, maybe people are fairly comfortable with this just being a mild pullback until proven otherwise. And if you don't really jive well with that, that's cool. We could take a look one step behind the curtain at the VVIX and further the point by just saying, okay, then why didn't the VVIX get price acceptance up and over the 103 handle, right? Usually the order of operations, if there's going to be a capitulation type sell, is that the VVIX signals the VIX to go, and then you see a big sell-off in the market, right? That's sort of the reflection of the order of operations. It just did not take place on today's session with that rejection back down underneath the 103 handle. And if we take a look at volatility futures, another interesting look here is just that we moved closer to backwardation. However, we're right back down in the firm contango. I mean, we never got close to the zero line in the first place, but this reversal of the volatility that the market was pricing in would once again indicate more comfort with the market as opposed to fear. Remember that when we move into a backwardation, it's more fear presently than at some unknown point in the future. So money managers do not want to allocate capital, whereas in this situation, when we're moving lower, less risk in the present day, more risk in the future. Let's allocate the funds now, generate some return, and potentially avoid whatever black swan is on the horizon. That's the general idea of this. We haven't talked about that in quite some time, so that's a general reminder. 9 versus 30-day VIX, same concept. Obviously, that's under the zero line. That would be in a contango. And the one-day VIX perked up, but we just simply don't have the data set yet to determine what that ultimately means. QQQ daily time frame chart. What do we see here from a trend perspective? Certainly a daily downtrend already intact with a daily lower high. These were not soft lows. We did actually flip into an hourly downtrend to achieve that pullback, and obviously from here to here, we have produced lower lows. I would also point out that this did not hold on the retest at 372, and we have closed the CPI gap. We actually got a perfect gap fill reversal off of it on the Tuesday session, but there's zero follow-through up and over the hammer high, which closed out from today's session. So we didn't even get a counter trend move to set the next daily lower high with that gap fill reversal setup in play. As of today's session, we've also closed underneath our daily 50 SMA. So it's not looking great over here in the QQQ Nasdaq side of things, and as we know, it's been that way for a little while with that observable lower high. Let's take a look at the hourly time frame chart and build a game plan a little bit more granularly for the remainder of this week. A lot of people have been talking about this as a falling wedge, which is typically a bullish pattern. And although that may be true, I would just advise that if we're looking for reversals here, I would want to see this turn into an inverted head and shoulders, but it's not just the break of the neckline because we're already in a daily downtrend. You need that extra layer of confirmation, high or low, over the 372 if you're going to more aggressively trade for upside outcomes. I mean, don't get me wrong, you could scalp it from here to here and you could try to take the break, but the higher confidence longs will undoubtedly come from a higher low confirming over 372. With the daily downtrend, with the hourly downtrend already intact as well, if we just get lower high acceptance beneath 369.50, we're trading for downside outcomes 364.50, lower bound of the expected move, and then your next level is 361.60. That comes from, if you remember back here, this was the inverted head and shoulders. It's your right shoulder at 361.60. For better upside outcomes over the 372, your target would be the big overhead supply zone, big battleground at 375.50. So even if we do produce something that looks like this, you've got a major contention here at 375.50. That perhaps could produce your next daily lower high, right? So be thinking about that even if we do rally. Anything from the anchored view apps here over on the QQQ side of things, I think they're confirming that, again, over time, these view apps will start to coincide with 375.50. This will become an interesting battlegrounds. And this, for the reversal, requires, right, you could imagine this sloping downwards towards the 372, or even if it takes a little while longer and it flattens out like this, maybe early next week, you're really not confident in longs until you can recapture that. And once again, that anchor point is coming from the Fitch downgrade to the credit, right? Let's take a look at the market internals for the Nasdaq side of things. Really not all that bad. Nothing breaches negative 400 million. This is not negative 300. This is negative 400 million out of the NQ side of things. The net volume flows are definitely approaching more substantial on the NQ side. We're typically looking for negative 600 million instead of negative 500 million like the NYSE side. So getting there, and once again, observable and measurable difference here on the bear side for your NQ. The advanced decline line, though, not even in trend lower zone on Tuesday. That to me is a bit of a head scratcher. And again, why is there no follow through on a mild sell day there that produces a hammer off of the gap fill reversal in the cash market? A little bit perplexing. So I would just be cautious about new money shorts with the internals not fully on board with the downside. Definitely more so here in the Nasdaq versus the NYSE. As you can see, the cumulative builds, they don't waver through the zero line. They actually get worse into the close instead of getting back above the zero line. But once again, this is not full-blown bloodbath. These internals, at least, I mean, the market price action is saying otherwise with the downside, but the internals, the underpinnings, are not really in alignment with an outright collapse or just massive, like I said, I guess there's no better word, but bloodbath. Let's take a look at the market profile for the NQ side of things. A little bit divergent in the sense that the upper string of single prints here is rejecting the highs. The value area actually is lower. It's overlapping to down, unlike the ES, which is overlapping to up. So less volatility here, and it just ties into the whole thesis that if you're looking for shorts, the NQ and the just generally Nasdaq side of the market is where the weakness is really shining through. So shorts are better in the NQ, longs are definitely better in the ES. Russell 2000 daily time frame chart. What do we see here from a trend perspective? I would argue that we're moving from this balance range to a breakdown from the balance range. However, it's a reluctant breakdown. Look at the lower wick from Monday. Tuesday's session, today is an inside bar. It would lead me to believe that we could be open to the possibility of a look below and fail, meaning look below, fail, hourly high or low back within the range over 193.50. We could rotate back up towards the top. Maybe you even use this as the top, as a closer target at 196.25. If I zoom this out, I want to remind you of the firm structure underneath us, right? Even if we do see continued pullback, I would be watching definitely for a weekly set of higher lows at 188.25 out of the Russell. Obviously, the implication would be that we could move lower into the end of the week, but your daily 50 SMA is here, and it's just a very well-defined breakout point from in the past. If we take out the Fibonacci's, just because this one is too good to be true, coming from the low up to the high, there's your 38.2. So ideal, picture perfect, beautiful bull flag consolidation from this perspective on the weekly holds up over 188.25. Let's take a look at the hourly time frame chart to get a little bit more granular in here. The one thing I would just reiterate on the hourly is that we had all of this time spent basically in the balance, and there's no release of energy as we break down. We get the gap down and there's some minor additional selling, but the buyers are the ones who step up and send prices back higher for the retest of the breakdown point, 193.50. So it's not bullish. And again, I'm not arguing that this is ready to make new all-time highs. However, I'd be very open to the idea that this certainly is interesting for a move back in the upward direction. Once again, 196.25 becomes the first target in sight. Let's take a look at the anchored view apps for our IWM. And lo and behold, again, this stuff is just sometimes too good to be true. The anchored view app from back here, where we just anchored the fib from, right? Or sorry, that's a little bit after the fib, but nonetheless, it's right in line with the bottom of the range. So if you can break and higher low above that, that's where you get that rotation. This one's in the midpoint of this as a range. I would think that the market gets sloppy and choppy around there. If you can position close enough to 193.50, I wouldn't really think of that as a major threat in the midpoint, once again, of what's already proven to be extremely choppy. Let's take a look at the internals for the Russell. Nothing to write home about here. It's the same thing as the S&P, basically the NYSE side of the market. The Nasdaq is the outlier in terms of overall weakness. And how about the market profile? You can see an extremely poor high. This is the main takeaway from the market profile on the Russell. It's the poor high from the Tuesday session, so that as a hammer candle is extremely interesting. If we need to repair the poor high, it would indicate a hammer high break as well, which would put us back inside of the overhead balance range, right? So that would build the case for upside being more favorable if we start interacting with the top. Once again, 193.50 on your IWM. Apple daily time frame chart is certainly not a pretty one post earnings with the gap and go here. However, we've got to contend with the bear flag and just understand the structure that is off to our left. So there's a minor gap to close here at 177 fills down to 175.70, and then beyond that, there's quite a ways to fall all the way to the next major structure at 170.40. So really keeping tabs on what unfolds here with Apple. If this bear flag breaks down, a measured move could take you very close to that structural target at 170.40. So being open to the idea that this may continue to have some legs in the downward direction, with the very mechanical long actually unwinding now that that channel has broken. Let's take a look at the hourly chart, because this is fairly telling. On this morning's session, with the gap up and over the bear flag consolidation, if there was ever an opportunity to squeeze out the shorts, this was it. Ideally, it would have been gap fill reversal, squeeze out the shorts, then you can walk up the targets. Clearly, it didn't take place, but even worse than that, into the afternoon, there's your lower high underneath 179.75. So definitely leaning more towards the bear side in Apple based on that evidence, looking for those downside targets. Like the broad market, if we are going to trade for upside here, please prove it first with the higher low, not just willing to take the break up and over 179.75. Let's take a look at Netflix. This is a patience play, totally range bound right now. You're getting either longs on a break and retest higher low over the 440.75, or flush the bottom, lower high underneath. You could trade for downside outcomes 415 on the flush of 427.50. Because we went wall to wall today and then produced a lower high, so from top of the range to the bottom, dead cat bounce lower high, I would argue that the probabilities would probably favor, no pun intended, downside here out of Netflix. So carrying that forward, but overall treating it as a range. Tesla is going to be similar, but it's starting to break down already. There's the balance range, and you can see, again, wall to wall, lower high, breaking the bottom. So as long as we're underneath 243.50, trading for downside outcomes in Tesla, your target is a very minor gap close over here at 235.16. If it does turn into a look below and fail, higher low back above retargets the top of the range, and that might be interesting for some upside into this area for setting up a short, right? We know that Tesla is already in a daily downtrend with highs, lower highs. We'd be looking for lower highs on the back test of the 50 SMA, right? Next up, let's take a look at Google. Leaving Google on the daily time frame chart just to continue to illustrate that this range, we're still above it. So in here, I would argue you want to be neutral. If we go to the hourly time frame chart, very similar to Netflix, there's your range, right? There's your wall to wall, there's your lower high. I wouldn't be thrilled about trading breaks even with lower highs under 129.10 because of the gap and structure off to our left from the daily chart that we were just looking at. Better downside is definitively moving into the gap, producing the lower high and getting the full rotation down to 123 to close it. For upside, your higher low needs to be above, on a break at least, over 131.50. Next up, Metaverse. What's going on with Zuckerberg's Fantasyland? This is what we want to see out of Netflix, basically, right? So there's the balance range. There's your break, lower high, and we're looking for continuation. I would be mindful that Metaverse on the daily chart is still in its mechanical uptrend. It is not like Apple. It did not break this trend. It did not break the 50 SMA, none of that, right? And we're pulling back from still a higher high. You could make the argument that maybe this is an hourly lower high, so on and so forth, but for the daily higher low, I would be open to the idea that we could produce something like that around 297.25, or the gap fill reversal, which is 301.80, and that was produced on today's session. So a little bit more follow through and looking for reversal patterns in here for the daily higher low to do something like this. We will have to recontend with this. There maybe is a short that sets up on the back test of 310, but as of right now, I think that the flush has already happened. You want to be thinking about going the other way now that the risk reward would favor and side with the daily trend. Let's take a look at NVIDIA. Not much to say about this one. Excuse me, I'm losing my voice here late at night. Anyhow, there is the balance range overhead. You flushed it. I think it's got to be a short at this point in my eyes. I'm not really seeing the argument for a better long. If you think about this as a balance range, you already had the opportunity for look below and fail once. Didn't happen. Target should have been the top of the range if this was truly going to hold. And then you had a micro instance of that here where you get look below and fail. If it was going to hold, should have migrated here and then kicked off the larger range, right? Something that did this to get up here. So there were too many opportunities for the sellers to fail. I think they're going to gain a little bit of a foothold here now that we're underneath this as overhead supply. So ideally, rejections just continue underneath 436.50 out of NVIDIA, and we can trade for some downside. I'm sure it's the downside that a lot of folks have been waiting for, saying that NVIDIA is overvalued, so on and so forth. Well, you finally have your daily downtrend. You're drifting lower highs, lower highs, lower highs, lows, lower lows, and definitively lower lows now. So I think that's the right way to be thinking about at least NVIDIA walking forward. Next up, Softy. Daily downtrend for sure, hourly downtrend for sure, equal lows sitting on them. So as long as we're in this range, looking for a range break underneath 321.85 target, becomes 313.50. The only long is if we do something like this. And even at that, I would be a little bit skeptical there and be thinking about this as larger head and shoulder, inverted head and shoulders, right? 334.50 would be the more prominent area that you would want to get up and over to really change the tone of the daily chart. If we do something like this, right? getting up and over that would produce, here's a daily inverted head and shoulders. And now you're starting to reverse the lower high and instead, or excuse me, lower low and go higher low. If we can break this, you're bringing in the higher high, right? So from a daily perspective, that's the better number, 334.50. Last but certainly not least, the mini beast, Amazon. And then you're on your way with a couple of trade ideas, 5 actually to get through. Long video today, and obviously it's coming out quite late, so drop the keyword if you know it. But nonetheless, Amazon, gap close underneath us is in play with the failure of this hammer wick to really support and keep us in the 3-day balance range. Let's go to the hourly time frame chart. I can illustrate that. Here you go. There's the lows, there's the lows, there's the lower high into the afternoon, looking for the gap range to continue to fill. That is underneath 137.09, minor level here to be paying attention to at 133.60. Full gap close is 129.82. Manage expectations. This is not a one-day trade unless CPI comes in and just wipes out the broad market as a whole. Just keep expectations intact, understanding that Amazon was a gap up and we're still technically above this as prior structure. So ease into it here, not just thinking that we fall off of a cliff and go all in one day. Speed round through the trade ideas. LUV, Southwest Airlines, is up first on the chopping block, looking at this as the possibility for an inverted head and shoulders, but even better than that, the reason it hit the scanner is because we have an inside doji setting up for a 3-bar play in the upward direction. Over 34.20 is interesting to get over that 200 SMA to close the overhead gap up to 35.40 roughly. This is not something with a large range. This is not something that moves very fast. This is a great idea to watch if you want to ease into some sort of swing trading or just trading in general. This is a great first idea at this price point as well. Next up, LOW, what's going on with lows? This is a longer time frame idea that could possibly play out. Double hammers back-to-back inside bar on today's session at a big level of prior structure. As long as we're holding up around 218, 219, 220, looking for an oversold bounce here out of lows. Ideally, we start closing some of these gaps overhead. The level where I would be interested is over the hammer high at 221.34, looking for the beginnings of a move in the upward direction. Again, it's counter trend here, considering that we did take out this prior higher low in the overall uptrend sequence from back over here. PG, Procter & Gamble, is up next. This is an idea as well to be thinking about for a breakout. If we're getting the risk off rotation, PG is one of those consumer staples names up and over 157.88. Gets fairly interesting, 158 as an even number. Just want to go out to a yearly time frame chart, see where prior structure is up next. I'd be thinking about 160 as a possible target, so about 3 points of upside, or you should just be generally trading for upside outcomes in this overall range until we come into the next major overhead structure here. Next up is sort of a 2-for-1, if you will. So let's go back to the daily and we'll jump on over to AMAT, not N. Applied Materials, very similar to our Oracle trade from the other day. Descending triangle, flat lows, and a gap to close underneath us. Under 144.16 closes down to 140.30. Similar comment. Honorable mention, AMD, AM Dizzle, what's going on over here? There is the same idea, right? Descending triangle, no gap, but thin structure back down to our psychological number at 100. And just as a reminder, here's Oracle, ORCL, there we are. And this is kind of exactly what we're looking for, at least out of Applied Materials, I would argue is much more so similar than AMD. But you get your lower highs, you get your flat lows, and there's the flush. Finally, right? It finally happened under that 114.28. So monitoring this into the full gap close at 110.15. If it pops back above, then we'll have to stop out and reconsider. But so be it. Oracle is looking pretty good so far. Next, last but certainly not least, now that we did the 2-for-1, is DDOG. DataDog just reported earnings and got smoked. But look at the inside hammer that printed on today's session, given today's volatility. I would just be open to watching this. If we can take out the hammer highs, I mean, we've got some gap range to trade for overhead. That number at around 89.15. If we can get some legs up and over that, the gap closes way up above at like 105 roughly. Not calling for that in one day, obviously, but there's some upside room to run if that does start to pan out. If we take out the bottom, not necessarily as interested. I wouldn't want to try to catch the falling knife on something that has a history of being in such an aggressive downtrend. And it didn't really bode too well throughout 2022, right? It was a big, sickness boom, and then everything kind of fell off the cliff there out of Datadog. So those are my trade ideas for you. Thank you so much for tuning in to tonight's episode. It's a midnight special at this point. We've been having some mojo issues. It's slowly coming back. I'm grinding through all of the data points that we needed to cover, and I hope you got some value from tonight's episode. So if you did, let me know in the comment section with that keyword or by giving the video a simple thumbs up. I hope to see you in the pre-market prep tomorrow for the infamous CPI print release. 8:15 sharp will be there, and I wish you all a green trading week.